Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for another episode of Zen and the Art of Real Estate Investing. We kind of have a first today because we're going deep on shopping centers. My guest is Andy Weiner of RockStep Capital, and he is a shopping center guy. This is a really interesting show. I got into it. We definitely talked a little bit about shopping centers on other shows, but nothing like this. What has he done? $230 million active under management, 27 plus years in the business, almost 10 million square feet built or acquired, and in 11 states. Let's get to it. This is episode 274 of Zen and the Art of Real Estate Investing with my guest, Andy Weiner. Andy is the founder and president of RockStep Capital. He is a shopping center investment specialist focused on hometown markets. Andy, welcome to the show.
Jonathan, excited to be here.
Yeah, I'm excited to talk to you. I know I was rushing to get here at the last second, but I'm really excited about this because we haven't really had a deep dive into shopping centers, and I know we'll get there, but I wanted to drop back and start with the name of your company, RockStep Capital, because I know that it's meaningful to you and it has a backstory.
It definitely has a backstory, Jonathan. So the word RockStep is not a word in the dictionary, but it is a dance move.
Yeah.
So dancers know what a RockStep is, and so I like big band music. I like Frank Sinatra, Ella Fitzgerald, Peggy Lee, Sammy Davis. So from the 50s, 60s genre of swing. And when you swing dance or couples dance or ballroom dancing, you're rock stepping on count 7 and 8. 1, 2, 3, 1, 2, 3, rock step or ball pivot change. And so we use the term rock step as a metaphor, okay, to be nimble, light on our feet, listen to the music in the industry, and then pivot. So if there's an opportunity, hey, Jonathan, we got an opportunity here, we need a rock step. Or Jonathan, we got a problem here, we need a rock step. So we use it as a verb, everyone here at the company. We've got about 100 employees. We're a vertically integrated real estate investment company based in Houston with assets in 11 states. Then I wrote an owner's manual for our company, and I wrote 25 rules of behavior, specific verbs, rules that everybody has got to live by. And we call these rules...
It's got to be the rock steps.
We call them rock steps. Yes, yeah. You win, Jonathan. Yeah. Congratulations. Yeah. Congratulations, Jonathan. So these are them right here. Yeah. They're in a little booklet. And we have a rock step of the week. And for the last 9.5 years, we've been rotating twice a year. It just so happens that this week is rock step number 2, practice A+ness, okay? And the joke my kids say, hey, Dad, there's a difference between an anus and an A+ness, okay? So every Monday, and it happened yesterday, the whole company gets on a Teams call and we talk about the rock step of the week. Somebody writes a little essay and they call randomly on people. What does it mean to you to be A+ in your personal life and your professional life? This is how we hire people. What are your favorite 3, Jonathan, and why? What are your most challenging 3? And why? We're required to live by these behaviors. It's how we manage conflict. It's how we build trust. We've got people from Brookfield and CBL and Blackstone who've come to our company who want to be part of a high-performance team that lives by certain behaviors. And so I'm emotional about this stuff. I go to the mat on this stuff. I cry over this. We talk about it. We use the language. We're not perfect. We're required to live by these rules with our investors, between everyone here at RockStep, our communities, our tenants, our lenders, our professionals, and it is the most important thing about this company.
Yeah, I love it. And I think it really should reign true for a lot of people listening right away that if you're going to start any business, especially one involved in real estate, but really it could go to any business, if you're not tied into your mission, you're going to struggle. Because I'm sure, let's go back to the beginnings, not even the beginnings of RockStep, but when did real estate play a role? Because I want to follow that trajectory into how you needed to know to create these RockSteps to make sure that everybody's on the same page.
Yeah, so it started before I started this business 28 years ago in 1997 here in Houston. Before that, I ran the operations for our family held chain of clothing stores. We had 159 stores. So it was a regional chain, the size of TJ Maxx. Mm-hmm. So stores, half the stores were in the big city metros, Houston, Dallas, New Orleans, half were in county seat towns. So I ran the stores. I ran real estate. I ran systems, logistics, finance, HR. And so I learned retail. I was a retailer, okay? And I'm a student of retail still today, and I study it. So I evaluate shopping centers. I evaluate tenants. I evaluate credit worthiness of tenants. I evaluate store metrics, company leadership, retail leadership. I'm a shopping center guy. I've been in thousands of shopping centers, thousands of markets, and have touched and seen these properties all over the world. And that's what we do. We're operators. We're shopping center investors. That's what we do.
What makes a good shopping center? Because I think that's a good place to start on the shopping center part.
Well, a shopping center is a collection of tenants. Okay, that's really what it is.
Yeah.
And you want tenants that will survive this world of Amazon COVID.
Yeah.
And provide needs to clients that they want to come there on a regular basis. So the shopping centers today are different than they were 5 or 10 years ago because Amazon and COVID drove out, eliminated, destroyed those that did not have an e-commerce strategy. And those that did develop their own e-commerce strategy, their fulfillment centers, their app, their fleet of bricks and mortars, and they have been able to not just hold market share against Amazon, but actually take market share back. And so what happened with Amazon COVID is that it wiped out the weak guys. Those that are left have strong balance sheets. They've got a great strategy, and they're telling Wall Street that we want to grow by 100 stores or 50 stores or 200 stores a year. But different than multifamily, different than industrial, there's no new product.
Yeah.
There's no new shopping centers, okay? So everybody's growing into an inventory that's not. And the supply and demand dynamics are in favor of this asset class. And so that's one advantage of the asset class. The second advantage, and so if you own second generation space, you're gold. So you own it cheaper than replacement cost. You have people coming at you who can drive rent growth. And then the second advantage of our space is that we're the major sector that has yield. Okay. So if an investor is interested in cash flow, in yield, in a preferred return that's current, we have what is called positive leverage. Okay. So that means that the cap rate or the yield at acquisition is higher than your interest rate on your debt. Yeah. So we're buying a grocery anchored center in Louisiana in about 3 weeks. It's got a 9. We're buying it at 9 cap or 9.25 cap. We're borrowing at 7.
Yeah.
So applying debt, we're increasing the cash flow to investors. We play in the enclosed mall space. So there we're buying at 15 cap, levering at 50% at, let's say, 7.5% interest rate, and you have 20% plus cash on cash returns for those kind of assets. So we have positive leverage. The multifamily space, particularly in the metros, they're valued at 5, 4.5, 5.5 cap.
Yeah.
But you're borrowing at 6 in some cases. And therefore you have negative leverage. And that requires a strategy of prayer so that you can pray that your net operating income grows dramatically so that you get out of a negative leverage situation. Prayer generally is not a good strategy in real estate.
Yeah, I really don't think you want to bank on that as your main strategy. But it's very interesting. I remember somebody saying that, when everyone was saying, oh, retail's dead, somebody said, well, listen, the cars in the parking lot aren't what show you that retail's dead or not, because the people who own the shopping centers, as you were saying, if they have a big e-commerce, say maybe people aren't going to Target as much, but they're ordering 6 times as much. And people do still go to Target. But it's interesting because when you own it, like you're saying, those businesses just need to survive. It may not show the same way as it used to in terms of people showing up.
So retail is not dead at all. Retail is in favor. And if you look at particular retailers, you see strength. I mean, that when you normally would. Let's talk about the book business. Did Amazon eliminate the book business? No, it did not. You're now left with 2 major players, Barnes & Noble, who's growing dramatically. They have figured out how to survive against Amazon.
Yeah, I did. It's funny that you say that, though, because I drove by a couple yesterday, and I was like, it's still in business. And I used to love to go there.
And they're growing.
Yeah.
Okay. And then Books A Million, we're buying a shopping center in Louisiana with Books A Million, and a significant part of their business is gifts, and they're going after children. They're going after parents who want the experience of walking into a store with their child to experience reading. And they have figured it out. They have a great balance sheet, and they're growing. And so that's an example of retailers you normally would think, I'm not sure, but they are both growing with solid balance sheets.
Yeah, it's really interesting because, I mean, as someone who's just been a consumer for years, sure, I use Amazon, but I do miss bookstores. You're balancing the price, and the conglomerate bookstores can price better, than the mom and pop bookstores, which make it harder because you look, and of course you can get it cheaper somewhere else. But as you're saying, these businesses that are succeeding in the large scale retail are figuring out other ways than just the one way, like just books isn't going to cut it.
Yeah. And another, I mean, there's certain subsectors in retail that are growing. The obvious one is off-price. So this is all the TJ Maxx divisions, Ross, Burlington Coat, Nordstrom Rack, Bell's Outlet. And so these companies have figured out how to turn merchandise. They have a cadence of markdowns that drives, typically they'll turn their stock 4 to 6 times a year. At our family business, we are only able to turn it twice a year. And then in addition, the capital required to not only open a store, but maintain a store is extremely low. So you'll see a TJ Maxx that does $15 or $20 million and 20,000 feet do more than a Macy's or Dillard's in 200,000 feet.
Yeah.
Okay. And then Macy's and Dillard's at department stores have an issue that there's so much capital that's required to refresh it. Unless the store does $25, $30 million minimum, they're going to be toast long term.
Yeah. And I see there's probably a big difference in what you have to do to manage because there's so much traffic in Marshall's, TJ Maxx, those stores that nobody is walking in saying like, oh, wait, so a couple things are out of place because it's literally a hotbed every day. Whereas in, you go to a regular Nordstrom's and if everything's not perfect, like the world ends. So it's 2 different kinds of seeing retail. Obviously, they have to be quicker. They have to get the merchandise back. But the expectations of shopping are different when you're shopping in retail that is already a discount and there's a lot of people looking, or high end.
Correct.
Yeah. And so, so when you're going in or evaluating a shopping center, I assume one of the first things you're looking at is who are the tenancies and are any of these likely to go out, and is it replaceable in this market?
Yeah. So look, and we operate, there's different types of shopping centers, Jonathan. So we operate in 3 types. And then I'll talk about geography. Yeah. So we operate in what are called grocery anchored centers. That's exactly what it sounds like. There's a grocery there and then space around it. Then we operate in what are called open air centers, non-grocery. Yeah. And the term in the market is called power centers. So this is TJ Maxx, Ross, Best Buy with some small shop space around it, Raising Cane's, McDonald's, Chick-fil-A in the parking lot, small pads. That is called a power center, open air, non-grocery. We operate in that. And then we also play in the enclosed mall space. And the enclosed mall space is the opportunistic sector where you're buying great real estate at mid-teens cap rates and are just cash cows. They just yield a lot of cash. Now, so that's the 3 subsectors we operate in. Our geography is what we call hometowns. This is secondary, tertiary markets that have some essential drivers. Usually populations under 1 million, often they could be under 250,000 or 150,000, but there's something different between a major metro and a hometown. A hometown has a spirit of community and a leadership in this community that's identifiable and impactful. Okay. There really is a difference. And the quality of life between schools, safety, community involvement, everything is dramatically different. And that's our geography, hometowns. We have a fund, Hometown America, going after income producing properties in those three subsector classes in Hometown America. And what we like about these markets, particularly in the enclosed mall space, is that you have an opportunity to get local business leaders in these hometowns to be part of the equity. And by reaching out to business leaders, hey, Jonathan, you're a business leader in a hometown. Tell me about this property. Tell me about your hometown. You know, is population growing? What's happening to industry? Is this location good? What's the reputation of this asset? And if you do that 5 or 10 or 15 times with leaders, your understanding of the market is better than anybody. And many of these people want to invest in institutional quality assets, okay, in their markets, but they need somebody who can bring capital and expertise to those assets. And by having 3 to 5 to 7 business leaders part of the equity, alongside my equity and other investor equity, we reduce risk. They help with entitlements. We never have a zoning problem. Incentives, property taxes, relations to the city, to the police department. They're effectively deputized leasing agents for alternative uses. They're on the board of the community college, the hospital district, the economic development district. And they are our advisors as we face opportunities and risk. And so we're the only one in the country that has this model. We call it the RockStep Coalition. Local business leaders to be investors, local community bank to be our lender. They want to lend, and you'll get fixed deals for 5 years with no prepayment penalties. So if interest rates fall, it's a phone call. If you have CMBS debt or you have insurance company debt, nothing happens. If interest rates go from 7.5% to 6.5%, and we're not assuming they will, but if they do, hey, Mr. Lender, would you go ahead and run this by committee at a 6.5%? It gets approved, and then you get an amendment, and within 45 days, your debt goes down. I mean, that's the advantage of that model. And then you get the city behind it. Okay, so local investors, local lender, city support. We've gotten multi-million-dollar packages in Minnesota, Kansas, Nebraska, in Louisiana. We're working in one city in the South that's going to give us $10 million of equity, and they're going to subordinate their returns for a redevelopment of that mall to new equity. And so you can build this coalition, and it supports our mission, which is to make Hometown America better. That is our mission as a company.
Yeah, I love it. I mean, you have everybody, with the same cause in mind when you have local bank, local leaders. And then I would think of the local leaders as what I call evangelists. They're people that you don't have to pay. You're involved in business, but who wants things to go better more than them? So they tell more people, hey, these guys, now you're not an outsider either. If you're coming from Texas and you're going into Minnesota, now you're linked in with all the people and they're talking good. It's just a much better relationship stack than I've seen.
And then I'll follow this up, Jonathan, by telling you that in the enclosed mall space, there's several buyers. They bought hundreds of malls over the last several years that run more of an asset depletion strategy. They harvest cash to their investors, but to the detriment of the property, the retailers, and the community, they let the property deteriorate. And oftentimes, communities and local investors will reach out to us, hey, come in here. Let's figure this out. Let's recapture the asset. Let's figure out what kind of incentives and local investors can come in here and put together the RockStep Coalition, and let's make something better here. Okay? Let's make a difference. And that's one of the drivers of our company. What can make a difference?
Yeah, and I mean, without those relationships, I don't see how you get through entitlement and all of the hurdles along the way. It's almost impossible if you're an outsider trying to kind of figure it out on the fly who can help you.
I'll give you an example. In Kansas, we own a property that required signage to keep national tenants there. And this was in a very tough entitlement market, and we needed signage. We put together a $400,000 signage package, emailed it to the city manager copied our investors in the market, and that's how it's done. Okay. And in New Orleans, we bought the Riverwalk from Howard Hughes Corporation with a group of local investors who we needed a city incentive, and we got an unbudgeted $1.5 million annuity from the city, where our investors went to City Hall and the mayor without my involvement, and they got it done. Okay, so in other words, could Andy have done it? No. Now, everybody's aligned for the benefit of the community, for the benefit of the asset. And this isn't about a community-centric alignment strategy. It's the RockStep Coalition.
Yeah, it really makes sense. And I think it works best in this hometown idea that you've said, million less in terms of that, because I think the larger the town, the more red tape, the more people that could get in the way. Whereas here, as I said before, it looks like everyone's really has the same goal here to make this work, revitalize the community, bring back local shopping, and help people all do well and give them opportunities to have places so they don't have to order everything on Amazon.
Yeah, I would also add that, Jonathan, I think we're really pretty much a red state strategy, or a red county in a purple or blue state. Mm-hmm. I'd call us a flyover strategy for people who use that analogy. And for those who live in the big cities of New York and Chicago and Atlanta, Houston, Dallas, LA, there's such a big difference between a hometown in terms of spirit, quality of life. And that's our geography, and that's what we love.
Hey, it's Jonathan. I hope you're enjoying this episode with Andy Weiner. If you're getting the bug for shopping centers, now is the time to figure it out. If you're thinking, hey, this hometown strategy works, I thought it was only big areas. It's not. Go to RockStep.com. There's a button that says Start Investing. You can scroll through. They do a lot of webinars. Get to it. But now, let's get back to Andy. So for someone, though, who's smaller and they're thinking, hey, I'd like to get involved in shopping centers, can they start this on a small scale and test it out, before they get to the true larger shopping center?
If they want to do their own investment by assets.
Yeah, like a 4 to 8 unit strip mall type of thing. Is that like a good training ground?
I actually think it is. So let's say you want, now again, could you develop new? The problem is construction's so expensive.
Yeah.
So I would recommend properties under $2 million that have 3 to 5 to 7 tenants in a part of the market that is viable. Okay. And again, what you look for is you're looking for what we call essential drivers. Does this hometown have something that drives growth? I'm talking about population growth.
Yeah.
Does it have a major university? Is there a military base or a government research facility, or both? Are there Fortune 1000 companies there? Is there a major hospital district? Is tourism big? You need something to drive population growth. And if it has that, then you can identify these smaller opportunities in these markets, and maybe from an operator who's not, their end of their life cycle, they want to sell it, it wasn't managed well, they're going to have to put down 50% equity or whatever the number is, and then put their balance sheet on the line. One thing I would recommend, Jonathan, is for people who aren't familiar with shopping centers, our mission as a company, besides making hometown America better, is that we want to be the country's leading educator in investing in shopping centers. So we have a learning center. So online, you go to rockstep.com, you go to the learning center, and we have dozens and dozens and dozens and dozens and dozens of articles about every single part of understanding a shopping center, the different types, how lease works, lease terms, everything associated with construction and design, how to manage, everything associated with it, articles, and then we have videos. So we have a YouTube channel called the Shopping Center Channel. And on Instagram, I'm the Shopping Center Guy. So you can go and follow us on Instagram. But if you like the idea of investing in shopping and you want to do it yourself, you need to study.
Yeah, okay? For sure.
You got to study, learn the terms, learn the different designs, and then you go from there. You got to figure out you got to figure out your capital exposure, roof, parking lot, lighting, those kind of issues. You got to figure out your tenant improvement dollars. What kind of absorption will there be if somebody leaves? What's the viability of each tenant? All that kind of stuff that you have to do, very frankly, in any sector in commercial real estate.
Yeah, I owned a retail fourplex for, I don't know, my dad owned it, then passed it down to my sister and I for like 30 years. And the changeover was always tough because it was a pretty smallish town in Westchester. We had the deli was an anchor. We had a gym, which of course failed at one point, like a lot of them do, because it wasn't a chain. And then we had physical therapy in two spots. But when one of them changed over, when the gym went out, it was very hard not only to find the lease that was going to match. We're trying to get some bigger hubs in Verizon, but the market didn't make sense. So as you're saying, like, it is really important to understand your market, because we didn't. I wish I knew of all these videos. Probably weren't there back 20 years ago, of course, but I need them.
Yeah. And the other piece of advice I could give, Jonathan, to somebody trying out is to recognize that unless you're diversified geographically, either in that market, that it might not work out on the first one.
Yeah.
And so that if you go into it, try to go into it for 2 or 3 at least. I mean, that's the advantage of any fund. Our fund has, 6 or 7 properties. One's going to underperform.
Yeah.
1 or 2 will overperform, and the rest will hit on target. And if you were unlucky enough to have just gone into a deal where it underperformed, that's not fun.
Yeah. But I think that, the lure of funds for people who haven't become passive investors but have income to do it is you do get exposure, like you said, to a variety of different types, in this case, shopping centers, geography, operators. And that's what creates the kind of almost no fail. Because as you said, okay, one didn't go well, but you'll learn from that. And that'll go into the next fund to hopefully make it better. But you're the more diversified you are, you expect to have one bad, one amazing. That's like startup investing to me.
Yeah. So we're in a transition, Jonathan, right now, where we were doing deal by deal syndications, and we have our fund now, Hometown America. And the reason why we've done this is that particularly in the opportunistic sector, enclosed malls, but also other types of shopping centers, sellers are almost requiring that you have a fund in order to win the deal. They want committed capital. And so, buying the property right at the lowest possible price is one of the most important indicators of the success of the asset, of the investment. So that's why we have a fund. Investors get the advantage of diversification. And because we're a yield play, we can pay a preferred 8%. That we pay a current preferred of 8%. That's what we do. It's a current yield play. And particularly in the enclosed mall space, we bought some malls, like we bought one in Kansas at a 17 cap with 50% leverage. We're returning 8% a year. And in this deal, 20% of the original capital per year without a refi.
Yeah.
That's without a refi.
Well, it gives you the advantage, too, as the buyer, because you do have the fund and obviously the reputation where it's going to knock out all those people who are, it makes sense. Why would someone want to sell to a one-off? It's very unreliable.
Yeah. So that's our game plan. And again, we look at every single mall opportunity on market and off market in the, in the mall space. And, there's, $40-50 billion of insolvent debt underlying malls. It's getting repriced almost at land value in some cases, but at mid-teens cap rates.
Yeah.
And that's where, and it's very, very good real estate. And in the mall sector, there's 3 strategies, Jonathan, and we employ all 3 depending upon the market and the asset. One is just harvest cash. It works. The architecture works fine for the next 15, 20 years. Just harvest the cash, pay back equity quickly. Second is arbitrage the periphery. So you buy something at a mid-teens cap rates. So we did this in Rapid City, South Dakota. We bought it at a 20 cap rate for $12 million, a mall there. We sold the periphery off for $18 million. We still have the mall throwing off $2.5 million of cash per year with no basis.
Yeah, that's nice.
And then the third one is shrink retail. Okay, shrink retail and do something else. So we're demauling 6 of our malls. One is led by Target. One is led most likely by Costco. 3 are Ross and TJ's, that is led by Ross and TJ's, and 1 by a hockey arena. City's building a $50 million hockey arena on our mall site.
Wow.
And as a result, we'll do multifamily and we'll do some hospitality there as well.
Yeah, I guess with all the talk of what happened with retail, you've dispelled a lot of the myths, but there's certainly a lot of real estate out there that's commercial, large-scale retail that could be repurposed, but not as easily as people think. So that's why it has to be a giant project like that to make sense.
One has to be a giant project, and oftentimes there's a gap, okay? And that gap is you need a certain return, but the costs are too high to get that return.
Right. Yeah.
Therefore, you need incentives. And so many jurisdictions are available for these type of incentives. And the nice part about shopping centers is that you can incentivize, use sales tax as an incentive. And sales tax is where the money is.
Yeah.
Sales tax, increment financing, property taxes, that doesn't drive a lot of cash. The cash is in the sales tax. And so if you want a redevelopment and you can capture either some of the increase in sales tax as a rebate to the sponsor, or you can even add a tax on your property. We've done that before. We add a sales tax on our property.
Interesting. Yeah, I mean, there's way more ways to make money and to be creative with this than I had previously thought. I wanted to talk about demographics a little because I'm sure you guys do your own demographic research, but doesn't it help that all of these large-scale anchor companies that are involved in these malls, they have huge demographic budgets. So when Target goes to put a new store somewhere, to me, I want to buy in that neighborhood if I'm a real estate investor. But does that help you as a shopping center investor to know that these large scale companies are spending all that money to know that they're going to be sustainable?
And the answer is yes, it does. And Jonathan, these companies use either internal software, oftentimes supported by external software. They pay a service, and these companies can estimate very closely the sales of a new store, and they can also estimate cannibalization. Cannibalization is when adjacent stores lose part of the business. So if a new Target opens up at $50 million, but you lose $10 million from the adjacent stores, that's a $10 million cannibalization. Your net effect is $40 million. Not $50.
Yeah.
Now, in secondary markets, when you open up new stores, oftentimes the distances to the next TJ Maxx is 50 miles.
Yeah.
So there's zero cannibalization. Zero.
Yeah.
Okay.
Yeah. That hometown strategy even more important than there as well, because your distance between stores is likely going to be much bigger than a large city where there's a Starbucks on every corner.
And there's another dimension to this. So when we look at a hometown, let's call it a TJ Maxx, we like low rents. We don't like high rents. So if TJ Maxx, same investment credit in a hometown, is at $9 a foot in rent, but outside my office in Houston, it's at $18 a foot rent. So the challenge is underwriting. So here, $18 at the end of the term goes to $19. And the question is, can you underwrite that they're actually going to renew the lease and go to $19 in a major metro? Well, around the property could be 2 or 3 or 4 other shopping centers that might have some vacancy. And to keep them in our center, maybe we got to drop the rent to 17. In a hometown, there's no vacancy and you're already at $8. And if they build new, it's going to be $20 rent. The probability of them renewing is extremely high.
Yeah.
And you can underwrite that growth.
Yeah. I mean, it makes it sound like your strategy can't be done in a larger city because just as you were saying, there's other opportunities for somewhere to move there if there's larger scale things. This really puts them in a good spot, but again, also helps everybody work together with the same goals because there aren't a lot of other options.
Correct.
Yeah, it's very interesting. So geographically, you said you're a red state favorite, but are there any geographies that you feel that you haven't been in that you're very interested in that might work for the strategy that you use with this hometowns?
Yeah, I will tell you, we're looking at every single secondary, tertiary market enclosed mall in this United States that's available.
Yeah.
I mean, we've looked at Alaska, looked a little bit in Hawaii, actually. We've looked in California, DC, Oregon. As you get into some of the blue states, it becomes a little bit more challenging. There's a little bit more tax risk and other political risk and employment risk. We certainly look up east in New England, but I would call it from the Rockies to the Southeast, Virginia, yes, Maryland, yes, Illinois, where you're seeing population falling, it makes me nervous.
Yeah, right.
Illinois makes me nervous. New York makes me nervous. Now, we've looked there because you can find great assets in red counties, okay, where there's less political and business risk in those markets, okay? But you've got to look and make sure there's essential drivers. Is there a university? Is there a strong hospital network? Is there a military base? I mean, we're looking right now at a property with one of the largest military bases in the country. I believe that the military theme is a very valid theme. We are remilitarizing. For the next 5 or 10, this is happening.
Yeah.
Okay. So, there's going to be a strong engine in those markets that have major bases.
Yeah, it makes sense. And it also seems like you really do have to stay on top of politically where things are going and how that affects what your investment strategy is, but also the trends of all of these stores and which way they're going. I wanted to touch on something that I found interesting because you brought up employment, and then I was thinking of the hometown strategy. I just thought that it's so much more important to keep these hometown, malls and shopping centers in because they provide so many jobs. If the whole thing were to go away, there would be a huge loss of jobs in the area. And obviously that would be another problem with rents going up, and people need to keep their jobs.
Yeah, but I actually define it a little different than what you're doing, Jonathan. Mm-hmm. I see that you have to have employment outside of the shopping center, which really keeps the retail jobs there. Okay.
Yeah.
So we're buying a center in Louisiana now in a city called Lake Charles, which is where our family business had our first store in Louisiana. There's a market of 100,000 people. And they announced 8 weeks ago the largest investment in the history of the state, a $17.5 billion LNG terminal, liquefied natural gas terminal, where there's going to be 8,000 employees for 4 years in a row in a market of 100,000. Okay. Yeah. And there's 3 other terminal expansions that will double that. Plus there's highway department. I mean, this market is going to go through effectively a Trump boom is what it is. Yeah. I mean, this is manufacturing, construction, pumping in money. And so we're buying an asset that was destroyed in Hurricane Laura 5 years ago that was rebuilt for $33 million, everything new. And we're buying it for $19 million at a 9 cap in a market where there's going to be 15 to 20,000 new jobs. They're not going to know where to put them all. They're not going to know how to fit them on the highway. So that can happen when you get into markets that have essential drivers. So there, it's just major employment.
Yeah, I mean, the cap rates are incredible if you just compare. I mean, I'm sure the listeners are thinking, oh, I've listened to so many multifamily shows where we're talking about 3 and 4 caps, and now you're talking, 9 to 20 cap on it. It shows that it's a really burgeoning industry where I think the general public would think that it's not, just in the way that we had said in the beginning, people thought retail is dead. It's nice to know that it's not, and there's opportunity out there.
Yeah, I mean, the idea where multifamily is valued at 4 to 5 cap and deals are getting, very frankly, it's absurd to me. Okay. Yeah. I'm living this world of 8.5 to 9.5 open air centers where you're borrowing at, call it 7, somewhere around there. And then the enclosed mall world is 12 cap on a great asset. I mean, I just talked to a guy today who's selling 3 malls off market in great markets where there's some redevelopment opportunity between 12 and 15 cap in hometowns. I mean, that's the world we live in.
Yeah.
And then if you can reduce risk by having local business leaders who can be our guide for all of the issues, many of the issues that affect risk, and you can make hometown America better, it's just fun.
Yeah.
Good investment, and it's fun.
Yeah. It just sounds like this has been your thing. But growing up, were you fascinated with shopping centers and retail? Because that was your family business.
That was our family business. Yeah. And I drove with my dad, and my grandfather. And look, I have been in literally thousands of shopping centers. I've probably been in over 500 Walmarts. I have been, I used to drive 35, 40,000 miles a year just to all these markets and walk. So when we look at a shopping center, what I do is, say we're looking at them all, I'll go in and I'll walk every store, the perimeter inside every store. Mm-hmm. So if you look at the walls, are they merchandising the walls? How much inventory do they have per square foot? Do they have a planogram? Is their planogram robust? Is there good lighting? Is it clean? And you can tell very quickly whether that store is at risk, whether that company is at risk, okay? And whether I need to say to our acquisitions group, you know what? The probability of these guys surviving is not as good as what we think. And so, look, I'm a student of retail. I love retail, and I love hometowns. They are they're a very special place, Jonathan. There is a portion of this world here in this country where many of the big city folks just don't get it. Just don't get it. I'm not being disparaging. I'm saying because they don't understand the vitality and the specialness of these hometowns, it's just a great place.
Yeah,
to live or to do business. Again, you might not have the New York Knicks or the Houston Astros as your sports guy, but you have a quality of life that is phenomenal.
Yeah, and it's easier to get that sense of community the smaller that you are and the more participatory everybody is. It's just been a really interesting kind of light that's been shined on it to me. And I look at it completely differently now. I always talk about reps as we wrap up. And it seems like your expertise comes from the amount of reps you got, not only as a child, but then getting into the business. I got those reps with a dad who was just looking at dumps all the time, flipping houses, buying houses. So I had those. And then when I got older, I just knew way more than I thought. Once you got into it full time, did you realize okay, I know a lot. And obviously now that's exponentially greater.
Well, I think the idea of reps is true. In theory, you get better. In theory, you learn from your mistakes so that the probability of mistakes going forward is lower. And if you hire great people who live by the rock steps and you find wonderful hometowns and you sort for assets that you can buy at the right price with the right hometown coalition, it's just a fun business.
Yeah.
And a good investment.
It sounds like it. Well, if people are interested and they want to get in touch with you and find out what you do at RockStep, is the best place for people to start at rockstep.com?
Go to rockstep.com. They can book a time on my calendar. I've got my calendar on there. We can book a time to talk. If they want to learn more about retail, the good and the bad, the shopping center industry, go to our learning center. Certainly, if they want to learn more about coming in on our fund or particular deals, they can learn about Hometown America. They can, we have a video on this. They can study that. And then when they're ready to think about diversifying into shopping centers, please consider us.
Yeah. Awesome. And you have a pretty decent YouTube channel out there with a ton of videos.
Yep.
And on Instagram, you are the shopping center guy, right?
And the shopping center channel on YouTube. Yes.
Awesome.
Okay.
Yeah.
So, hey, Jonathan, thanks. Really a thrill to be part of this. And anyway, if anybody wants to learn about shopping center, please come to rockstep.com.
Yeah. All right, Andy, I really appreciate it. It's been enlightening for me. I feel like I just got entire tailwinds of all of the industry that I needed to know about. So I really appreciate you spending the time.
Of course, Jonathan, a pleasure.
Yeah, thanks. That was Andy Weiner. He's the founder of RockStep Capital. Again, you can find them at rockstep.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 275 of Zen and the Art of Real Estate Investing. And it's Kent Ritter of Hudson Investing. This is a multifamily real estate investing show, but with deep expertise and a focus on creating lasting communities, they help their investors live happier, wealthier, and better. He founded the company in 2019, and since then, they have total acquisitions almost 200 million, almost 130 million active under management, 1,300 units acquired. Kent knows a lot. We go into his background. Can't wait for you to hear the show. Next episode. I'll see you then.